Warren Buffett is always ranked near the top of Forbes' list of the richest people in the world, and virtually all of his net worth has been generated by investing. What kind of personal wealth are we talking about? Well, tens of billions of dollars, give or take a dime or a dollar. As the CEO of Berkshire Hathaway, his investment holding company, Buffett is typically paid only $100,000 a year. And unlike many hedge fund managers, Buffett doesn't skim a large percentage of the investment profits he generates. So how did he do it? 2 words: value investing. And we'll come back to that in a moment. Buffett always had a nose for making money, even as a young child growing up in Omaha, Nebraska. While still in elementary school, he sold packs of Wrigley's gum and cans of Coca-Cola, both future investments for him. He bought his first stock at the age of 11. And Buffett filed his first tax return at the age of 13. His father was a congressman, and Warren moved to Washington, D.C. during World War II. He got a paper route there delivering the Washington Post, another future stock investment. At 14, he used the profits to buy farmland in Nebraska. As a teenager, he and a friend also bought pinball machines and put them in barbershops, splitting the profits with the shop owners. Buffett went to the Wharton School at the University of Pennsylvania, but got homesick and returned to the University of Nebraska to finish his undergraduate degree. He applied to Harvard for graduate school and was rejected. It turned out to be a blessing in disguise because he was accepted at Columbia University in New York City and studied under the man who would change his investing life, the pioneer of value investing, Benjamin Graham. Buffett, although he had invested in the stock market since he was 11, had felt he was spinning his wheels with a variety of techniques until he came across Benjamin Graham's approach, which viewed stock as ownership in a business, and which sought to buy stocks at a discount from the underlying asset's intrinsic value. After Columbia, Buffett returned to Omaha and worked at his father's brokerage firm. He also kept in touch with Ben Graham and ended up joining his mentor in 1954. A couple of years later, Graham decided to wind down his investment business, and so Buffett went home to Omaha, this time for good, to set up his own investment business. He did so through a series of partnerships that he managed, which were in essence hedge funds. In 1969, however, before he was even 40 years old, Buffett decided the stock market was overvalued and shut down his investment partnerships. He recommended 3 options to his partners at the time. First, take the cash from the liquidated partnerships. Second, invest with his friend, the value investor Bill Ruane of the Sequoia Fund. Or third, take the shares in a not very big company he controlled called Berkshire Hathaway. Berkshire, of course, would go on to become one of the world's largest conglomerates. It would come to own Geico Insurance, Duracell, Dairy Queen, NetJets, and dozens of other businesses. Berkshire also amassed huge amounts of stock in Coca-Cola, Wells Fargo, Walmart, Bank of America, Kraft, Heinz, American Express, and many others. Buffett originally acquired Berkshire shares in 1962 under the framework of a typical Graham and Dodd type investment. I mentioned Benjamin Graham, but by Dodd, I'm referring to David Dodd, a colleague of Graham's at Columbia. The two wrote the classic book, Security Analysis, known on Wall Street as the Bible of value investing. Graham and Dodd focused on finding investments selling at a discount to the market, and which also generated positive cash flow. At the time, Berkshire was a struggling textile maker. Now, the textile business never turned around, but Buffett used the cash flow to acquire other businesses. These new acquisitions snowballed into others. One of its investing hallmarks was insurance, which historically accounts for the bulk of Berkshire's profits. Think about your car insurance payment, which you mail in and never see again. The term float means an insurer has the use of your insurance premium for a period of time, from a day to months to forever, before it has to pay a claim on your behalf. The time value of money is a boon to an investor like Buffett, who can put it to good use. Buffett likened Graham's value investing approach to a cigar butt with at least a few puffs left in it. Eventually, Buffett moved away from Ben Graham's strict approach to value investing to incorporate the strategies of the growth investor Philip Fisher and Buffett's future business partner Charlie Munger, who liked investing in high-quality companies for the long term. He stayed true to Graham's approach of buying companies at a discount, but now his focus shifts to buying high-quality companies, especially those companies with a durable competitive advantage, or what Buffett called a moat. A moat is just what it sounds like. It's a buffer around a company's core business that makes it very difficult for the competition to attack. Did you ever wonder why certain industries have a small number of competitors while others have hundreds of thousands? For example, there are two main commercial aircraft manufacturers in the world, Boeing and Airbus. Want to create your own commercial jet company? Good luck. The odds of succeeding are slim. Yet there are more than 600,000 restaurants in America. There are two popular approaches for determining if a company has a wide moat: Porter's 5 Forces and Morningstar's Economic Moat Framework. Michael Porter is a Harvard Business School economist who in the 1980s developed a framework to help explain the impact of industry structure on performance. Today, it's generally referred to as Porter's 5 Forces. The first of Porter's 5 Forces is the threat of new entrants. Certain businesses require a ton of capital to get started. The Boeing and Airbus commercial aircraft manufacturing business is case in point. Automobile manufacturing is another example. The idea behind the force Porter called the threat of new entrants is this: the harder it is for a new firm to enter a certain market, the greater the competitive advantage of the firms already in that market. The second of the forces is the threat of substitute products or services. Some products, say a patented drug, have no substitute. Most industries, however, have a variety of substitutes: Coke versus Pepsi, Ford versus GM, coffee versus tea, and the list goes on. The fewer substitute products or services, the greater the competitive advantage. Porter's third force is the bargaining power of customers or buyers. The internet has given customers great power. Best Buy went from being a dominant company to one struggling to survive due to customers searching for better prices on Amazon.com and other websites. When you're buying a product that many customers consider to be generic or replaceable, like a standard TV or washing machine, price competition tends to be fierce, and you can often search around for a great deal. In other words, your bargaining power is very high. Conversely, if you want the latest smartphone or a hot concert ticket, you'll probably have to pay up. The weaker the bargaining power of customers, the greater the competitive advantage. The fourth force Porter talks about is the bargaining power of suppliers. A great example of this is the De Beers cartel of South Africa, which amazingly controls about 35% of the diamonds produced in the world. De Beers has extraordinary bargaining power when dealing with jewelry merchants. Another example is OPEC. During its heydays in the 1970s and 80s, when it controlled a huge chunk of the world's oil supply, giving the group great power. Conversely, clothes can be manufactured fairly cheaply at many places around the world. So companies like Nike have a lot of power in their supplier relationships. The bottom line is that the less a firm is impacted by its suppliers, the greater its competitive advantage. Porter's fifth and final force is intensity of competitive rivalry. Firms in the airline industry, such as US Airways, went bankrupt, often more than once, due to intense competition. The cell phone industry is very competitive, with smaller firms attacking the larger incumbents. Conversely, the less intense the rivalry, the greater the competitive advantage. So Porter's 5 forces again are threat of new entrants, threat of substitute products or services, bargaining power of customers, bargaining power of suppliers, and intensity of competitive rivalry. Analyzing these forces can be invaluable in helping us uncover the size of a company's moat. But Morningstar, a firm known for its research on mutual funds, went one better. Morningstar created a framework for its research rating to be based to a large extent on a company's moat. Like Porter, Morningstar identifies 5 forces, or what they call factors, that provide a company with a moat. Morningstar calls its first factor the network effect. Why do people shop at eBay? Because there are tons of items for sale. Why do people join Facebook? Because nearly all their friends are on it. Why do people shop at Amazon.com? For the huge selection as well as the millions of reviews. Morningstar believes a network effect occurs when the value of a company's service increases as more people use the service. Morningstar's second moat-creating factor is intangible assets. Clearly, a patent is an intangible asset that provides legal protection lasting up to 20 years. A brand name is also an invaluable asset that can be hard to quantify, but easy to see in action. Putting the words Disney or Apple on a product is almost a license to print money. Morningstar's third factor is cost advantage. The concept of cost advantage can easily apply to many other industries as well. For example, there are many stories of Walmart and Home Depot driving their smaller competitors out of business because they couldn't match the larger firms' low prices. Having a cost advantage not only drives competitors out of business, but it also gives these companies the opportunity to raise prices without worrying about losing the bulk of its customers. The fourth factor Morningstar identifies is switching costs. Imagine if you had a new alarm system installed in your house. It'd probably be pretty expensive to rip it out and install a new system, even if the new system had lower monthly fees. Or consider the QWERTY keyboard system. It would take you quite a bit of time to learn another typing interface. The same concept applies to the products of many firms. For example, it might be a challenge to maintain your same level of productivity if you switch from Microsoft software to another productivity suite, even if the other software were objectively better. Morningstar's fifth factor is efficient scale. Efficient scale relates to a niche market served by a small amount of companies, in some cases only one company. For example, many small to mid-sized cities can only support one airport. The airport owner in this case would benefit from efficient scale. The same logic applies to a hospital. Building a hospital is a massive undertaking, so there's likely only one in each town or small county. So Buffett came to believe that a better approach to value investing would be to buy at a discount, high-quality companies, with a moat around their business. Let's look at a few examples where he put this idea into action with incredible results. His 1963 investment in American Express is perhaps his first major purchase in sync with this philosophy. The story begins with an everyday food item, salad oil. American Express may be known today for its credit cards and traveler's checks, but the firm has also operated in a number of other financial-related businesses. One was called warehousing, where they would lend money against the inventory of a company's goods. These goods would be located in a warehouse that Amex's employees could inspect. So a company called Allied Crude Vegetable Oil Refining Corporation borrowed money against its inventory of salad oil. The main problem was that the company committed fraud, filling huge barrels with water and salad oil sprinkled on top. Well, eventually someone blew the whistle and the fraud was uncovered, with the result that Allied Crude filed for bankruptcy. At the time, Amex was on the hook for a good portion of the firm's borrowings, to the tune of $150 million, or about $1.5 billion in today's dollars. In the wake of the salad oil scandal, Amex's stock fell 50%. Buffett thought this was a bad but temporary misstep by Amex and that its core business was still intact. It still had a moat around its traveler's check and charge card business, and he felt the damage to its brand would eventually be repaired. Buffett bought 5% of American Express, a huge 40% of his partnership's assets at the time. The end result? Buffett sold his partnership shares in Amex about 5 years later at more than a 5-fold profit. Buffett has long since staked a new position in American Express and added to it over a quarter-century period, bringing to mind one of Warren Buffett's most famous quotes, "My favorite holding period is forever." Warren Buffett's purchase of Coca-Cola provides another telling example of his value plus moat strategy in action. He began buying Coke for Berkshire Hathaway in 1988. At the time, Coke was trading at a PE of about 15, not outrageously cheap, but well below its historical average of 20 plus. PE measures a stock's value by taking its price per share and dividing it by earnings per share. The lower the number, the cheaper the stock. Coke was selling at depressed levels for several reasons. First was the market crash of 1987, when the Dow Jones Industrial Average fell more than 22% in a single day. Second, Coke had made several missteps. Perhaps their most famous blunder was the new Coke debacle a few years earlier, which had customers clamoring for the taste of Coke's original classic formula. In addition, Coke had purchased Columbia Pictures, a business well outside its core competence. It ultimately sold Columbia to Sony at a profit, but received sharp criticism for the box office bomb, you've probably forgotten it by now, Ishtar. Ishtar lost $40 million in 1987, a huge sum at the time. Enter Warren Buffett. He correctly reasoned that any damage to the Coke brand was temporary, and that the moat was still very wide. Buffett realized Coke's greatest asset is perhaps its marketing and distribution network, making it difficult for competitors to mount any real challenge, even if they had a better product. Buffett once most famously remarked, "If you gave me $100 billion and said, 'Take away the soft drink leadership of Coca-Cola in the world,' I'd give it back to you and say, 'It can't be done.'" The gross margins on Coke's products were huge, up to 80%, basically giving it a license to print money and generate a ton of free cash flow. Coke was also a play on the emerging market consumer. Consumption tends to increase throughout the world as GDP and personal income increase. Buffett's original $1.2 billion investment in Coke, with additional occasional purchases, came to be valued in the neighborhood of $16 billion, plus billions more in dividends received. Now, not everyone has the temperament to buy assets with problems when things look bleak. Were you dying to buy financial stocks during the financial markets crisis of 2008-2009? Probably not. Well, Warren Buffett was. He invested in Goldman Sachs, General Electric, and later Bank of America. And as you might guess, he made a bundle. Buffett put one of his most famous maxims to work during the crisis, namely, be fearful when others are greedy, and greedy when others are fearful. But first, a little context on what led us to the financial markets crisis. The epicenter was the housing industry and subprime mortgages lent to people with poor credit ratings. Perhaps the most famous type of subprime mortgage were the so-called ninja loans. No income, no job, no assets, no problem. Others called these liar loans, since the borrower didn't have to verify the income or assets they put on the mortgage application. Bank risk managers believed that, well, if the person can't pay the mortgage, we'll simply take the house as collateral. The house probably went up in value, so we won't lose on a diversified portfolio of these loans. Interest rates were low in the mid-2000s, and mortgage-related products with subprime mortgages had higher yields than conventional prime, which were given to people with good credit ratings. If investors want something, in this case higher-yielding investments, Wall Street bankers will give it to them. Wall Street has an expression, when the duck is quacking, feed it. Of course, we know the end of the story. Consumers defaulted on their loans, and real estate prices crashed. Excessive leverage on part of both consumers and banks led to financial disaster. Now, if you purchase a house with 20% down payment, this results in leverage of 5 to 1. But many banks were levered at a ratio of 30 to 1 or more. Suppose you put $10,000 down on an apartment that costs $100,000. The bank has lent you $90,000, so the leverage or debt-to-equity ratio on this single home is 10 to 1. Suppose the house drops 10% in value to $90,000. Well, the $10,000 cushion the bank had protecting itself from the bad loan has now disappeared. The investment bank Bear Stearns was one of the first casualties of the housing crisis and financial tailspin from 2007 to 2009. It ended up being sold to J.P. Morgan for $2 a share. And Lehman Brothers, an investment bank that had been around since 1860, ended up declaring the biggest bankruptcy ever. Merrill Lynch might have gone bankrupt if it hadn't been bought by Bank of America. And AIG, one of the world's largest insurers, needed a bailout by the U.S. government, and likewise for the bank holding company, Citigroup. It was in this financial environment in September 2008 that Warren Buffett had the confidence to invest in Goldman Sachs and General Electric. Many people don't know that for many years, GE received the bulk of its profits from its financial services arm, GE Capital. Buffett invested $5 billion in Goldman and $3 billion in GE convertible preferred stock with a 10% dividend. Preferred stock is a hybrid investment that has characteristics of a stock and a bond. So as long as the firms didn't go bankrupt and Buffett's multi-billion-dollar investment bought the firm's time, he would get a very attractive 10% dividend each year. And if the stocks recovered, he would get to convert his preferred stock to common stock at the September 2008 price when he made the investment, resulting in an even bigger windfall. The end result? You guessed it, by March of 2011, Buffett earned a $3.7 billion realized and unrealized profit on Goldman Sachs, and by September 2011, he made at least $1.2 billion from his GE investment. A few years later, Buffett made a similar investment in Bank of America, which was having problems recovering from the financial markets crisis. He invested $5 billion in Bank of America convertible preferred stock, paying a 6% dividend with the option to convert them into 700 million shares of common stock at any point within the next 10 years. The end result? Just 4 years later, he turned in an $8.4 billion profit in both realized dividends and unrealized capital gains. Buffett claims he came up with the idea to invest in Bank of America when he was in the bathtub. If that's true, it might have been the most profitable bath in history. It's hard to think of a business that will be around longer than selling ketchup. Well, maybe funeral homes and tax services. You know the old saying on death and taxes. In 2013, Buffett partnered with the Brazilian private equity firm 3G Capital to buy Heinz for $28 billion. You probably know Heinz is the maker of ketchup, but it also sells hundreds of other products as well, such as Ore-Ida French fries. Part of Buffett's success is that anyone would take his phone call to discuss a merger or investment. He was usually viewed as a white knight, since he generally leaves existing management in charge when he makes an investment. So even though Heinz was doing fine on its own, when Buffett and 3G Capital came calling, Heinz's management was willing to listen. Buffett put in $4.5 billion in cash and invested another $8 billion in preferred stock of the new Heinz, which paid a 9% annual dividend. Roughly 2 years later, Buffett and 3G Capital swapped their stake in Heinz for 51% of a new firm, merging Heinz with Kraft. Kraft is another huge multinational food products firm. 3G Capital is a private equity firm, so naturally, debt financing was also part of the equation. The end result for Buffett? Quadrupling his money in about 2 years. But even the Oracle of Omaha, as he is sometimes known, can make huge blunders. Buffett often refers to Berkshire's purchase of the Dexter Shoe Company as one of his worst investments ever. In 1993, Buffett paid $433 million for the Maine-based shoe company. Buffett's biggest mistake wasn't that Dexter's shoe business deteriorated rapidly. Instead, Buffett laments that he paid for the deal in Berkshire stock, which has since risen 12-fold or so since the purchase. Using some basic math, this means that Buffett paid the equivalent of $5.2 billion for a virtually worthless shoe company. I think Buffett learned from this lesson since he rarely used Berkshire stock in future acquisitions and had a successful investment in the dominant casual shoe company, Nike. Buffett, like many investors, also had a disappointing experience in airline stocks. In 1989, he invested $358 million in the convertible preferred stock of US Air. It appears he escaped relatively unscathed before US Air went bankrupt, but it was still a disappointment. Buffett himself once said, if a capitalist had been present at Kitty Hawk back in the early 1900s, he should have shot Orville Wright. Of course, the implication is that many investors have lost money in the many airlines that have went bankrupt over the years. Although Buffett's known mostly for his stock investments, he also invests in other securities, such as bonds. In 2007, he purchased $2 billion in the debt of a Texas utility known as Energy Future Holdings. The company was the subject of a leveraged buyout, or LBO, and choked on too much debt. Buffett's net loss on this investment was more than $900 million. His investment in IBM was also criticized by some investors who viewed IBM as a dinosaur in a technology world dominated by Google, Apple, Facebook, Amazon, and the like. Buffett first started buying IBM in the first quarter of 2011. He invested more than $13 billion in IBM at a cost basis of $170 a share. When I last checked, IBM was trading at roughly $160 a share, resulting in a paper loss of more than $750 million at the time. Back to the big picture. Buffett had success written all over him at a very young age. But it wasn't until he came across the value investor Ben Graham that his investment strategy began to take shape. Buffett initially embraced the strict value strategy of Graham by looking at companies in a quantitative manner, trying to buy companies at the equivalent of 50 cents on the dollar. Buffett's contribution to the concept of value investing was to find high-quality companies selling at a discount and to let the moat around these companies protect his investment, enabling him to hold them for his favorite holding period, forever. In the end, the numbers speak for themselves. In the 50 years after Buffett took over Berkshire in 1965, the S&P 500 was up 11,355%. In contrast, over the same period, Berkshire stock was up an amazing 1.6 million%.